Imagine this. You've done everything right. You've saved diligently, you retired on schedule, and now you're sitting down to review your Medicare premium notice. And the number staring back at you is hundreds of dollars more per month than you expected. You didn't get a warning, nobody called you, it just showed up. That's what happens to thousands of retirees every single year because of something called IRMAA, and most of them had no idea it was coming. Here's what makes this even more frustrating. In many cases, it could have been avoided entirely. Sometimes it comes down to just a few $1,000s of income that push someone over a line they didn't even know existed. So today, on Retirement Security Simplified, we're going to fix that. I'm going to walk you through exactly what IRMAA is, how it gets triggered, and most importantly, the specific strategies you can use right now to keep your income below those thresholds and protect your Medicare costs in retirement. Let's get into it. IRMAA stands for Income Related Monthly Adjustment Amount. I know that's a mouthful, so think of it this way. It's a surcharge, an extra charge added on top of your standard Medicare Part B and Part D premiums because the government has determined that your income is above a certain level. Now, a lot of people hear the word surcharge and assume they did something wrong. You didn't. IRMAA isn't a penalty. It's simply an income-based pricing system built into Medicare. But that doesn't make it any less painful when you're the one paying it. Here's the part that catches most people completely off guard. IRMAA is not based on what you're earning right now. It's based on your income from 2 years ago. So if we're talking about your 2026 Medicare premiums, the Social Security Administration is looking at your 2024 tax return to determine what you owe. That 2-year look back is everything. It means that by the time you see the surcharge on your bill, the income that caused it is already in the past. And if you didn't plan ahead, there's very little you can do about it at that point. This is exactly why understanding IRMAA before you retire or in the early years of retirement is so critically important. The decisions you're making right now about your income are setting up your Medicare costs 2 years down the road. So, how much are we talking about? Let's look at the numbers because this is where it gets real. Medicare has a standard Part B premium that most people pay. But once your income crosses certain thresholds, you start paying more. And the increases happen in tiers or brackets, similar to how tax brackets work. For individuals, the IRMAA surcharges begin once your modified adjusted gross income, we'll talk about what that includes in just a moment, exceeds around $106,000. For married couples filing jointly, that threshold is around $212,000. And as your income rises, the surcharge increases at each tier all the way up to the highest bracket. Now here's the thing that really gets people. It's what I call the cliff effect. These brackets don't phase in gradually. They're hard cutoffs. That means if you earn $1 over a threshold, just $1, you jump into the next bracket and you owe the full surcharge for that entire tier. Let me put a real number to that. A married couple who crosses the first IRMAA threshold by just $1 could end up paying more than $2,000 extra in Medicare premiums for the year, combined between Part B and Part D for both spouses. Same coverage, just a slightly higher income on paper. That's not a small difference. That's real money leaving your pocket every year simply because of where your income landed on a tax return 2 years ago. Now you might be thinking, okay, but I'm retired. I don't have big income. This probably doesn't apply to me. Not so fast, because IRMAA doesn't use your take-home pay or your checking account deposits to measure income. it uses something called your modified adjusted gross income. And that can include a lot more than most retirees expect. Here's what gets counted. Your Social Security benefits, up to 85% of them are included. Your required minimum distributions from your IRA or 401k included. Pension payments included. Any income from annuities that you're drawing from included. Investment income like interest, dividends, and capital gains included. And if you do a Roth conversion, the amount you convert counts as income in that year as well. Here's one that surprises almost everyone. Even interest from tax-exempt municipal bonds gets added back when calculating modified adjusted gross income for IRMAA purposes. So even income that feels tax-free isn't necessarily invisible to Medicare. The bottom line is this. Retirement income adds up fast once you factor in all the sources. And when you combine Social Security, RMDs, investment income, and any other distributions, it's very easy for a comfortable but not extravagant retirement income to push you across an IRMAA threshold without you even realizing it. Okay, so now that you understand what IRMAA is, how it's calculated, and what triggers it, let's talk about what you can actually do about it. Because there are real proven strategies that can help you manage your income and stay below those thresholds. Strategy number 1, Roth conversions, done at the right time. If you have money sitting in a traditional IRA or 401k, every dollar you pull out in retirement is taxable income, and it counts towards your modified adjusted gross income. Roth accounts work differently. When you take distributions from a Roth IRA in retirement, that money does not count towards your modified adjusted gross income. It's completely invisible to IRMAA. So, one of the most powerful long-term strategies is to convert some of your pre-tax retirement savings to Roth during the years before your income gets too high. Ideally, you do this in the window between retirement and when your required minimum distributions begin, when your income tends to be at the lowest. The key word here is strategically. You don't want to convert everything at once and spike your income so high that you'll trigger a high IRMAA tier in that conversion year. The goal is to convert in controlled amounts over several years to gradually reduce your future taxable income without creating a bigger problem in the short term. Strategy number 2, qualified charitable distributions. If you're 70 and a half or older and you give to charity, this strategy could be one of the most valuable tools in your entire retirement plan. And most people have never heard of it. A qualified charitable distribution, or QCD, allows you to transfer money directly from your IRA to a qualified charity. You can do up to $105,000 per year this way. And here's why it matters for IRMAA. That money satisfies your required minimum distribution for the year, but it never shows up in your taxable income. It goes directly to the charity without passing through your hands or your tax return. For someone who gives to their church, a nonprofit, or any qualified charity, this is an extraordinary tool. You're doing something you were already planning to do anyway, and in the process, you're keeping your modified adjusted gross income lower and potentially staying below an IRMAA threshold. Strategy number 3, using fixed indexed annuities for income timing control. This one is particularly powerful, and it's one that most financial media doesn't talk about enough. When your money is growing inside a fixed indexed annuity, that growth is tax deferred. The interest being credited to your account does not show up on your tax return. It does not count towards your modified adjusted gross income, and it's invisible to IRMAA until you choose to take withdrawals. That last part is the key. With the right annuity structure, you get to decide when income starts and how much you take each year. That level of control is something that very few other financial vehicles can offer in retirement. Compare that to a traditional investment account where dividends, interest, and capital gains are showing up on your 1099 every single year, whether you wanted that income or not. With a fixed indexed annuity, you're in the driver's seat. You can time your income to stay within a specific IRMAA bracket, intentionally and consistently. Strategy number 4, managing capital gains and investment income. If you have taxable brokerage accounts, the income they generate can push your modified adjusted gross income higher without you making any active decisions. Mutual funds, for example, often distribute capital gains to shareholders at the end of the year, even if you didn't sell anything. A few things to consider here. Look at whether your portfolio is positioned in a tax-efficient way. Consider tax loss harvesting. That's selling investments that are down to offset gains elsewhere in your portfolio. And pay attention to whether you're holding assets long enough to qualify for lower long-term capital gains rates rather than the higher short-term rates. None of these are complicated moves, but they can make a meaningful difference in where your modified adjusted gross income lands at the end of the year. Strategy number 5, coordinating withdrawals across different account types. Most retirees think of their retirement savings as one big pool of money, but strategically, you want to think of it as different buckets, and the order in which you draw from those buckets matters enormously. If you pull everything from your traditional IRA, your modified adjusted gross income goes up. If you blend those withdrawals with tax-free Roth distributions, your modified adjusted gross income can stay lower. By thoughtfully sequencing which accounts you draw from each year, you can often keep your income in a lower IRMAA tier without changing your lifestyle at all. You're spending the same amount, you're just being smart about where it comes from. Now, before I close, I want to mention something many retirees don't know about. If your income has dropped significantly due to a major life event, you recently retired, you lost a spouse, you got divorced, or your income changed substantially, you don't have to just accept an IRMAA surcharge based on old income. You can appeal it. The Social Security Administration has a form called the SSA-44 that allows you to request a reduction in your IRMAA surcharge based on a qualifying life-changing event. You don't have to wait 2 years for your lower income to automatically filter through. You can act now. This is absolutely something to discuss with a knowledgeable advisor who can walk you through this process correctly. Let's bring this home. IRMAA is one of those hidden costs of retirement that almost nobody warns you about until it's already showing up on your bill. But the good news is it's not inevitable. With the right planning, the right income strategy, and the right timing, many retirees can significantly reduce or even eliminate these surcharges altogether. The most important thing to remember is this. Because of that 2-year look back, the income decisions you're making right now are already shaping your Medicare costs in 2028 and beyond. Planning ahead isn't optional. It's the only way this works. If this video helped you, please get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. If you found this video resourceful, please give it a like and subscribe to Retirement Security Simplified so you don't miss future videos just like this one. And drop a question in the comments. I read every single one. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.